to the Money Garden on steroids. Right now, I'm just going to post a pretty quick video that's going to kind of give a math-based explanation for shorting a company and buying options about shorting a company. I have some videos coming out that do a really great job, in my humble opinion, that give kind of a high-level overview about what it is, give really solid analogies that explains it. But this is just a math-based way. This will pair really well with that video, or a few of them actually. But this is just a really black and white way of doing it. Also, I'm posting this because there's an opportunity, an investment opportunity if you choose to jump on it. So first, in order to talk about buying options to benefit from the downside of a company, I'm going to start with just kind of the basics and just kind of walk you through. So if, let's just say we're looking at Kroger, who is the biggest, one of the biggest and one of the best run grocery stores, in my opinion. So we're just going to take a quick look at this stock. So here you can see right now it's trading at $47.09. Now, if you just do a traditional, you just buy some shares, let's just say you buy a share, you're going to pay $47, we're just going to round it, and eventually you're going to sell it. And of course, when you sell it, hopefully it's higher than what you bought it for. You're going to buy it, sell it, let's just say $55. And if you only bought one share, that's an $8 profit, right? Just the difference between buying it and selling it. And if you bought more shares, of course, by 10 shares, you made $80. Now, if you're going to short a company, that's where you're trying to profit from it going down. And a really great example for it, it's not mine, actually, I'm borrowing it from another YouTuber. It's as though, your friend has an iPhone 10 and they go out and buy an iPhone 11 and they have this iPhone 10, it's just sitting there, and I tell them, it's cleared of all the data, no pictures are in there. Can I just take this now, and whenever you ask for it back, I'll just give you this one or another one. And if they're okay with that, I then take that iPhone 10 and I sell it on eBay. Then let's just say, in a couple of years, my friend says, oh, you know what, can I have that iPhone 10 back? My mom wants a phone. Then I can go to eBay and just buy another one and then give it to my friend. All right, so I sold it before I bought it, and I profited from that difference. Right, so that's really what it is. You're just swapping this, buying and selling around to profit from the downside. So here, if you're going to do Kroger, if we're going to short Kroger, I don't plan on shorting Kroger, but just as an example, you're going to sell it before you own it. So again, right now it's trading at $47. If, let's just say, it then comes down to $40, then you're going to benefit $7. And again, if you have more shares, right, 10 shares, you're going to have $70. Now, I don't short companies typically because there's a lot of risk. Also, for me, the benefit isn't as high. You don't have as much. You don't have any leverage. So if, let's just say, I short Kroger, I sell it before I own it. I sell $47 worth, and let's just say I only have $150 in the account, and then something happens and Kroger, is suddenly worth $200 a share. Now I'm liable for that difference. I'm liable for more than I have. My brokerage, of course, is going to just liquidate my position because they can't be on the hook for if Kroger goes up to $2,000, right? They can't, so they're just going to liquidate my position. It's called a margin call, and so if that happens, my liability is unlimited. Also, I'm paying a premium, and so the longer I hold it, the higher the premium. It cuts into my profits. I'm not a fan of shorting companies. Instead, I buy options. Now, the cool thing about an option is it's just a contract. So I'm signing a contract, and I have the right to execute that contract. So here I'm going to give you another math-based example. Now, this is on it to go up, right? So it's called a call option if it goes up. Again, a future video is going to do a really good job of explaining the differences and, again, the high level. But right here, we're just going to show you kind of the math-based. So if we're going to buy a call option on Kroger to go up, there's there's going to be a premium, right? You don't get it for free, and that's where the brokerage comes in. Let's just say here. Let's go here. Let's show you kind of where this comes from. So we're going to go to Kroger. And we're going to take a look at their options. And on here, I actually picked this in advance. We're going to say January 20th of 2023. So there's a contract. The contract has an end date, an expiration date. So in this case, it's January 20th, 2023. And again, we're going to buy a call option. We're trying to profit from it going up in this example. So then we're going to hit go here. So just take a look. So this is both of them, calls and puts. But I only changed this just to simplify the view. So it just, because I know I'm looking for a call option, it's just easier. Now, I already broke down the premiums. So the bid and the ask is the premium. And I wrote down the bid. Now, the reason I do that is you may not get either one. So this is going to be based on what the market shows. So, if I try to execute this contract, I'm going to, click buy, and I'm going to do that later. And then they'll take it off to the open market, go to the floor, and then they're going to get the best price they can. Now, the only reason to really worry about the bid and ask is if you're going to have a limit order. A limit order says only if the price is within a range of this number, then go and execute this contract. I don't do that, because if you notice here, the difference is 15 cents. When I buy an option, I'm expecting a big price move, and I don't really care about 15 cents. If the price goes the other direction, I might not get into the position. I would rather just take whatever price they give me so I can have my position. It's a sure way to get the position. So I just use the ask price, but it's really not that big of a deal. So if we look at the ask price, that's going to be the premium. Again, it's going to vary when the contract is actually executed, but it's typically in that range. So the break even, so again, the strike price is the price where the contract is executed. So you're going to have this minus or plus the premium is going to be, like here in this case, the premium is $4.65. The break even point is $50.65. So if I buy an option with a strike price of $46 that expires in January, then if by January the price is $5.65, I broke even because I covered the premium. It's even, right? So now let's just go with this one, $47, a premium of $4.10. The break-even point is $51.10. Now let's just say the price goes up. It goes up to $70. So the profit is going to be the difference between the market price and the break-even point, right? And then because you're controlling 100 shares, it's the difference times 100. So you made $1,890. Okay, so that's a call option that's benefiting on going up. So now we're going to do a put option, which is where it goes down. So again, this is the math-based version. So if we're looking for a put option, we're going to go back over here, and we're going to look at the puts. Again, this is just filtering it out. And I've already got the ask price written down here. So if let's just say, because it's currently trading at $47, the premium is $3.85. The break-even point is $43.15. So then let's just say the price goes down to $42. Then my profit is the difference between these two times 100. So, $1.15 times 100, $115. Okay. Now, so that's how it works. These are the fundamentals. Again, this is going to pair really well with the video I'm going to post in the future. Now, the opportunity that you might want to look at is Airbnb. I think Airbnb is obscenely overpriced. That's my opinion, and I'm going to show you why. So first of all, the PE is the price to earnings. There's actually several measurements that kind of determine whether or not a company is expensive or cheap. Now, this is measuring how much money it's paying towards the stock price versus how much money it's making. So in this case, I'm paying $63.85. For every $63.85, I'm chasing $1 of earning. That's really high. Now let's take a look at the trailing 12 months and the future 12 months. So we're going to look at the charts here. Airbnb, we're going to look at the technical indicators, lower indicators, and here fundamentals. and you're going to see the trailing 12 months TTM and the future 12 months FTM. Now, of course, the future 12 months, that's based on projections, projected earnings. That has a higher likelihood of being wrong. And in this case, I actually think it's really wrong. So we're looking at 63.29 is the trailing 12 months. The projected price to earnings, because they're expected to make more money, is 53.89. That is still really, really high. So of course, what's considered a normal rate can vary depending on the market. But I mean, in a normal world, you're looking at 27 as a decent price to earnings. Depend if it's a growth company, maybe even more. If it's a very basic, a solid, well-established company, maybe 15. 63 is really high. Another measurement to whether or not a stock is expensive or not is the cash flow. It's really the price to cash flow. So the cash flow is how much money it's making, how much revenue it's making, greater than its cost for operating activities. So, so in this case, the price to cash flow is, again, how much you're paying per dollar towards the stock compared to the cash flow, and that's 46.12. Now, it's hard to have everything measured or memorized as to what's a good price or a bad price. So you can even just run a Google search. I actually do that all the time. So here, good price to cash flow is 10. Anything below 10, we're looking at 46. That's insane. That's really expensive. Now, one of the reasons that people, in my opinion, think that it's a good price is if you look at the 52-week high. The 52-week high is $212, meaning at its peak it was $212. So people look at its current price, $115, and saying, "Oh, you're getting it at a discount." The problem with it is Airbnb became a publicly traded company in 2020 when the stock market was its most extreme, the most extreme bull market. So it's really not an accurate measurement. And then the other key thing here is the CPI report, the Consumer Price Index, is coming out on Wednesday. That's another version of the inflation rate, and most people, myself included, expect it to be really high. So if the CPI or the inflation rate coming out on Wednesday is high, coupled with the jobs report that just came out that was also really good, the Fed is likely to increase the Fed funds rate. So if you're not familiar, it makes the availability of cash harder. It makes it more expensive. And so the market usually tanks when the Fed raises its rates because it's not good on the stock market. People are going to pull their money out because it's bad on businesses, and it's also bad on people who are investing in the stock market. It makes the availability of cash more expensive. So I expect that the CPI is going to be high, and that's going to cause the stock market to go down significantly. So if you wanted to buy an option, a put option on Airbnb and going down, I'm going to walk you through that process. And again, feel free to make the trade, do your own research. This is more just about showing you, on a step-by-step process how to do this. So we're going to look at Airbnb. So now we're going to go to options. And again, we're looking at put options. So that's just assuming it's going to go down. And I like to pick something way off into the future. And so I'm going to go with January of 2023. The longer off it is, the more volatile it is, which is to your benefit if it goes in your direction. Also, it's hard to know what it might do in the next week or two, but the longer period of time, the easier it is to know it's going to move in the right direction. So if we're going to say by 115, right now it's trading at about 115. Go ahead and click on the ask, but it really doesn't matter. So then it's going to take you to this screen. Again, I don't do limit orders. I do market orders because I don't want to risk not getting in the position. And then again, you're paying for 100 shares, and you're paying 100 of the premium. So you're paying $115. So then you would hit preview order, and you would buy the order if that's something you're interested in doing. So I hope this is helpful. Again, this is going to pair really well with some videos that are coming out. I don't have the exact time frame on those, but I hope you found this helpful, and have a great day.